What's up, guys? We'll start top of the hour, maybe a minute or two after. Okay, testing, 1, 2, 3. Testing, 1, 2, 3. News. Yeah. So we're about an hour away from the Fed meeting. 94% chance, at least the last time I looked, 94% chance that they're going to cut interest rates. We can go over that data. But anyways, roll it. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Welcome to the Forex.Today YouTube channel. I do this because you're a subscriber. I did not send out an email. I did not send out a tweet. I didn't post it to Facebook. I didn't tell my mommy, my daddy, my neighbor. This is for you because you subscribe. So today, the Fed is going to cut interest rates. So we can take a quick look at the Fed watch and see if it's changed over the last day or so. Okay, so we can take a look at that. Then I would like to go through a PowerPoint presentation and go over what the Fed is, what monetary policy is, who the FOMC is, what do they do, why do they do it, what's an agenda like. Then we'll have the news release, we'll get the volatility, there's a press conference, and then call it a day. Maybe it's 2 hours. What do you think? Smell like a plan? I know we know each other, but hi, my name is Wayne McDonald. I'm the Chief FX Market Strategist for Traders Way. So if you are enjoying these videos and webinars that I do for you every single day, please pay it back. Visit tradersway.com, open an account now. Also, other ways for help. In the description below, there's a link to download my chart templates. You can also click the link below, go to Traders Way. You can click a link below, go to FX Bootcamp to get video training. We also have live performance coaching if you need a real person to be your drill instructor and do whatever it takes to make you successful. You can go to live.fxbootcamp.com. Hey, I wrote a book 13 years ago. It's still a great selling book called Strategic and Tactical Forex Trading. You can go to YouTube to Amazon.com for that. There's all kinds of resources made available to you. They're all there to help, no matter what style you need. There's ways. Of course, coming into these webinars as a subscriber to Forex.Today is also a help. So, lots of resources. You're welcome. Ciao. So you guys excited? Fired up. Me too. You know, loving life, living large and in charge. Oh. Coffee, 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 water, 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 coffee, 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 water, 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 wine, 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 sleep, sleep, sleep. There's my cycle. Anyways, hey, you know what? Before we do this, let's do something else. By the way, feel free to ask questions, be involved. We're just hanging out. I'm just hanging out. A couple of currency traders, huh? Do 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 do. Bum 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 bum. Okay. So chickadee, check this out. If you lend the U.S. government $98.17, they'll pay you back $100. Isn't that cool? That's how that works. By the way, this is banks lending banks money. Oh, I'm thirsty. This is banks lending banks money to meet their reserve requirement ratio set by the Fed. 10% of all deposits at a bank must be parked at the Fed. Well, during the ebb and flow of deposits and withdrawals and deposits and withdrawals, this changes every single day. And so sometimes they're a little short, just a little bit. It's not a problem. Their balance sheet's fine. They have assets that are performing. But sometimes they're a little short and they have to borrow from another bank and say, hey man, we're a little short on our Fed funds requirements. Lend us some money for today. I'll pay you back tomorrow. And I'll meet that requirement. And tomorrow will be fine. I'll settle everything and I'll pay you back. So literally it's like an overnight loan. It is an overnight loan. So right now, kind of interesting, right? So there isn't an interest rate. There's just, I'll lend you $98.17. You pay me back $100 tomorrow. Fine, good, nice and dandy. Okay, cool. So this has to do with pricing. These are short term. It may not be overnight. Maybe it's overnight. Maybe it's a month. Maybe it's 3 months, that kind of thing, okay? So this is really bankers talking to each other. Okay? Bankers talking to each other. Negotiating, in fact, short-term loans. And what do they incorporate in the short-term loans? Default risk? Nah, JP Morgan's not likely to default on Bank of America on a 3-month loan, right? You know, that's not a realistic risk. right? There's duration so short. Well, I shouldn't say duration. The time frame, the maturity, time to maturity is so short that there's not much risk involved there. The major risk with these loans is, well, what if interest rates change? Aha! If interest rates change, prices change. There's an inverse relationship between price and interest rate. So if they made a short-term loan to another bank and interest rates change, they risk having, less opportunity cost. So they have to price that in. What this means is based on all known information on the short run. Short run means, right, variables shouldn't change, but the risk is, what if the interest rates do change? How are you going to compensate me for that? And that is price. So as these deals are negotiated, remember, these are not opinions. This is not a survey. This is negotiations, billions and billions of dollars worth of real money negotiations between smart money bankers. And they price all these no known information and unknown information. It all gets priced in. And based on the price, you can derive what they thought the yield would be, or what the interest rate would be, or more importantly, the change in interest rates over time. So that's called the Fed Watch tool, okay? So notice that they have today's date there. That's because there's a Fed meeting, December 11th. There's another Fed meeting, January 29th. There's another Fed meeting, March 18th, another Fed meeting, April 29th, another Fed meeting, okay? So here's all these Fed meetings. Well, what could possibly happen at a Fed meeting? Well, they could announce a change in interest rates. So we know like the time that might happen. So it comes down to, in these negotiations, what each party believes or thinks the interest rate will be at that time. And based on that, they're like, I'll loan you money, but you're going to have to compensate me for this risk, okay? So it gets priced into the negotiation, and you can figure out what they thought the interest rate was by the change in price. So that's the first thing. These are Fed meetings. Second of all, watch the price. 98.17. December 11th. 98.45. January 29th. 98.49. March 98.55, 98.59, 98.61. Okay? So these changes indicate, the change in price indicates the interest rate that was used to come up with the price. Okay? Isn't that neat? So 99.4% chance right now, based on the price, that the Fed raises cuts interest rates today from 175 to 2% to 150 to 175. Isn't that cool? So Danielle says, if they cut interest rates today, why was the dollar weak? Because they think it's the end. But anyways, all this can change today based on not just what Powell says at the press conference, but how the market interprets today. Doesn't have to be actual, just interpretation of what happened. So what if the FOMC board is split? Half said they wanted to cut interest rates. The other half said we shouldn't cut interest rates. They cut interest rates, but only because Powell was the tiebreak. Now it's very uncertain whether the next meeting, right? So in that case, the certainty will change, and therefore the price that they start negotiating for the next meeting should change. Okay? So according to this, let's go back to this one. Let's take a look at this more closely. So we believe, the market believes, they're going to cut to 1.5%. December, they believe 72.4% of the market believes will still be at 1.5%. No cut in December. Small chance, okay? 27% said there'll be another cut, right? More than 2/3, almost 3/4 of the market are negotiating, or right now, billions of dollars in contracts based on no cut. Okay? So they've done their research. That's why they're smart money. They've done their research, and that's what they're actually doing right now. They're selling money at that rate, basically, right? How about this? January, 56% chance no cut. March, 52% no cut. Do you see? So that's why the dollar's been weak all month. They're already negotiated the deals. They've already done the deals. Okay? Forex Academy, just shut that down, all right? Stop saying things like that. It's so silly. All you need is whatever, dude. All right. All right, so let's go through. What is the Fed? What is the FOMC? What do they do? What does this mean? How does it all work? Let's go through this, all right? So you guys ready for some macroeconomics? Prince Philip says, what I don't get is that if the rate is cut, the dollar is strong because people move money. No. You're missing, okay? Wow, there's a storm going on outside. Hopefully I don't lose internet today. Okay, let's do this. Okay, let's do this. I have a bond for 3%. Okay? I have it right now. I have a 10-year T-note from 18 months ago. It pays 3%. What does a 10-year T-note pay right now? 1.8%. Okay? So, is it worth more or is it worth less than a brand new 10-year T-note paying 1.8? If I were to sell it right now, it's worth more. It pays 3%. Of course you want 3%. So if you're going to buy it from me, you're going to have to pay me a little premium, right? Okay. Well, what if I have a 10-year T-note I bought this morning? Pays 1.75 or 1.8. The Fed cuts interest rates in an hour. So tomorrow, it's not going to pay 1.75. Well, let's get rid of the 10-year T-note. I think that's going to be confusing. I buy a Treasury this morning, and it pays the Fed funds rate of 1.75. The Fed cuts interest rates in an hour, and tomorrow you could buy the same a fresh cut Treasury, but now instead of paying 1.75. It's going to pay 1.5. Okay? Let's do it that way. You can buy it right now, 1.75. If you wait an hour from now, it's going to be 1.5. You've already decided you want to buy a treasury. Okay. Hey, thanks for stopping by Forex Academy. Appreciate it. Thank you for all the value you've added. Okay. Yeah, you need to buy a treasury, so you're going to buy it today. Why are you buying today? Because they're cutting. That's what it's all about. You see what I mean? They're buying because they're cutting. You got to get it today, or you're going to lose out. Think of it as a big fear of moving out, fear of missing out. Okay? Does that make sense? So once they stop cutting, there's no reason to buy. Everyone is where they are. Okay? So I did a presentation about 10 days ago about behavioral finance and why that works, and I give a better example, but just think of it that way. You better buy it now, dude, so there's demand for the dollars. Okay? Anyways. Okay, who's the Fed? Well, it has to do with also being a reserve currency, right? So people want the US treasuries because they're safe. Why? Americans pay taxes. When you go to a poor country and people don't pay taxes, then the government is likely to default because they don't have any money. Okay? All right, cool. So that's all it is, guys. It's the faith that the United States has a tax base, okay? Cool. So anyways, let's go to the purpose of the Fed. They have a dual mandate. They got to keep the economy healthy, and they got to keep inflation in check. You want some inflation. That's called growth. Imagine a business that never grew. It never lost customers. It never gained customers. There wouldn't be much reason for the value of the stock to change, and no one would really invest because they're not getting a deal and all that kind of stuff, right? So you want some growth. Well, the consequence of that is you need to put money at risk to create the growth, and that can create, cycles. That's true in business, and it's true in the economy, okay? So they need to monitor the economy, make sure it's healthy. What do I mean by that? People have jobs. If you got no money, you got no car, you got no woman, and there you are. I think that was Gandhi, or maybe it was Confucius. I'm not sure. Okay? So you got to have a job, and therefore you have money, and then money you pay all your bills, and whatever you have left over, you buy cigarettes, diapers, and, beer. Okay? So then when you do that, that pays for someone else's salary. They go out and they take their salary and they go to Supercuts and they get a haircut. That spending now creates income for for Supercuts, and then they can pay the hairdresser. The hairdresser has money. She goes out and buys diapers and cigarettes, and it just keeps going around the economy, and that pays for the policemen and the firemen and all this kind of stuff, and everything works because you got money and you spend it, okay? Now, when everybody's filthy stinking rich, this drives up inflation, and that's not a good thing, because then suddenly the fact that everyone has money doesn't do much because you can't afford to buy anything because prices are too high. So think about 2007. Everyone was filthy stinking rich, but nobody could afford a house. Nobody could afford gasoline because gasoline was $5 a gallon, up from 99 cents, right? So everyone was rich, but everyone was poor. So inflation's not a good thing, but you do have to have growth, okay? And so that's why they need to balance these two things. So, for example, the Fed would like the economy to grow at 2%, okay? 7%, way too much. It's too much, too fast. It's going to drive up prices. That creates inflation, and therefore to fight inflation, they're going to have to jack up interest rates and cool the whole economy off. That's not good. But that's not where we are now, right? The economy is growing at less than 2%. Uh-oh! Well, how do you spur the economy? You make money available. Well, it is available. There is lots of credit in the United States. But the second part is you make it affordable. Okay? So that's what this is all about, all right? Now, how do they do it? Well, they can adjust the reserve requirement ratio, which is the amount of money banks are required to deposit at the Fed. So if you're JP Morgan or Bank of America or Wells Fargo, you have money parked at the Fed. The Fed is a bank for banks. Okay? Now, a bank manager can say, yeah, okay, I have to have this money at the Fed, but I got this extra cash laying around. I don't really want it in my vault, so I'm going to park that at the Fed too. That's excess reserves. They're not required, but a bank manager can make that deposit, and it just parked at the Fed. Whenever they want it, they withdraw it. They're, hey, Fed, give me my cash. Not a problem. Okay? So those are excess reserves, and this is important because we're going to do math later. Yeah, we're going to do math later. They also have this thing called open market operations, and this is done by the New York Fed. Okay? And they have that as a tool as well, and I'll go through all this. Now, money supply versus interest rates. Okay? This is a supply curve. You may be familiar with economics. Okay? Has anyone here studied economics? Can't find my drawing tool. Where's my drawing tool? I guess, oh, I rebooted this, right? Okay? If you remember economics from university or maybe high school, you will know that typically supply curves are not vertical. Okay? Typically, a supply curve looks like this, okay? And that's a demand curve looks like that, and a supply curve, okay? This is typically a supply curve. This is typically a demand curve, okay? And you look for equilibrium, right? Okay? That's typically how it looks. So on this side, we got interest rates. On this side, we have the quantity or supply of money. How many dollars are there? Okay? So here's the interesting thing. Money supply is the money supply. It's not sloped like this, like a typical, because it doesn't change with interest rates per se. Whenever you increase the money supply, that is the money supply. At that time, it may be greater, so you quantity 1, now it's quantity 2, so as you can see, this means there's more, but that's it. Now it's that's it, right? Right? So it's always vertical in this kind of economics, okay? So that is the money supply. So the Fed uses tools to adjust the amount of money in the economy, okay? And I'm going to show to you how this impacts the interest rate. And then I'll show you why they're going to cut interest rates today. You guys with me? Huh? You liking the sauce? Cool. So let's move on.com. Okay. The Fed has decided to buy bonds. Thank you, Benji. Fed buys bonds, okay? So the money supply, like I just said, moves from quantity 1 to quantity 2. Now, how does that happen? How does that work? The Fed calls up JP Morgan or Goldman Sachs or Bank of America or Wells Fargo or whatever. Actually, there's 12, I think. Isn't there 12 primary dealers? So I might have mentioned some that are not primary dealers, but let's just say JP Morgan. They're one. They call up JP Morgan. They're like, sell us some bonds. So the Fed buys bonds from JP Morgan. The Fed didn't go to their vault for the money. They clicked a few keys and said, okay, send us your bonds. We'll transfer you some money. They just made the money up on a computer. Boom! They give it to JP Morgan. JP Morgan now has real money in their account, okay? So the amount of money now in the economy has gone up. See, if they bought it directly from the government, it would go from the Fed to the government, and now it doesn't get spent by people. And there's an important distinction because of the multiplier effect. So if they just gave it to the government, it doesn't do anything, okay? Because the government's just going to spend whatever their budget is. So they have to buy it from a dealer, aka the public. Huh? That's neat, right? So they call up JP Morgan, sell us some bonds. They're like, okay, transfer us some money, we'll transfer you some bonds. Where do they get the bonds? JP Morgan calls the Treasury, sell us some bonds. So JP Morgan transfers money to the Treasury. The Treasury sells them bonds. Then they pick up the phone, call the Fed. Hey, we got your bonds ready. So now the Fed transfers more money than JP Morgan paid the Treasury. Yeah, JP Morgan and everybody else front runs the Fed. The Fed doesn't care. The money didn't exist. They made it up. So they don't care. They get what they want. What happened? They now have bonds on their balance sheet. Now remember, you probably hear about this. The Fed is trying to unwind their balance sheet. So the Fed gets bonds, puts it on their balance sheet. In exchange, they give JP Morgan money. JP Morgan already used money to buy the bonds in the first place, so they collect the spread. They just simply front run the Fed. Yes, they don't give the Fed a good price. They give the Fed a bad price. Well, they make profit doing this. And the cool thing is, it's a phone call, right? So they make millions, they make billions of dollars front running the Fed. How cool is that? But that money is now in the economy. Okay? That's all this means. So when the Fed buys bonds, the money didn't exist. The Fed made it up. They popped it into the economy. And the quantity, the supply of money has gone up. And I don't mean cash. I mean ones and zeros. And or cash. And or bank vault. And all this kind of stuff. Okay? But the Fed can sell bonds. This is what they were doing earlier. Unwinding their balance sheet. There's two ways to unwind your balance sheet. Let the bonds mature, which means they just expire like bad milk, and then that's it. They expire, they're worthless, they're gone. Okay? The second way of doing it is sell it to somebody. So now what do? You call up JP Morgan again. Hey, Jamie Dimon. Yeah, it's JP. Yeah, I want to sell you some bonds, dude. Jamie Dimon says, yeah, I'll give you 98 cents on the dollar. And they're like, sure, whatever, dude. JP Morgan, boom, he just made his bonus. You ever wonder how they make like $30 billion profit in a quarter? Because the Fed calls them up and gives it to them for free. Boom. So like, he's really, I'll give you 98 cents on the dollar, man. And the Fed's like, yeah, whatever, we don't really care. Boom, free money. Okay, so what happens now is the Fed takes the bonds out of their vault, gives it to JP Morgan, they own it. But they take the money back from JP Morgan. And the amount of money in the economy is gone because what happens is that they're just ones and zeros. It's not actually cash, right? The ones and zeros is swifted over to the Fed. And what does the Fed do with it? Nothing. But it's not in the economy. You don't have access to it. The banks don't have it. It's just not there anymore. It's parked at the Fed. It's not in the real economy, right? So the supply of money can actually fall. Again, we're not talking cash. We're just talking ones and zeros, okay? Cash is just, there's the amount of bills out there. And in fact, the Treasury doesn't even know how much is out there. But whatever, okay? Now, based on the interest rate now has to do with the demand for money. Now, what do you use money for? What do you use money for? You want to spend it. People spend it. Companies invest it. Okay? Corporations invest money. Human beings spend money. You want to buy something. So when the economy is good, there's lots of demand for money. When the economy is bad, there's less demand for money. And this demand Because remember, supply is fixed. On this date, that's the amount of money there is. It's not a variable, right? So it's fixed. There's the fixed amount of supply. The demand changes. Okay, so we're looking at the demand side of the equation. What happened to my drawing tool? Hang on, I can't find my drawing tool. It was just here. What the? Oh, there it is. Weird. All right, so check this out. The equilibrium point, and this is the key part of economics. Okay? Based on that, based on the demand for money, so we call this D1, the money supply one, where they cross, is the interest rate in the economy. Okay? So IOER, Greg, has more to do with E. Remember in the beginning I said there's R and E, and pay attention to this because there's the math. That influences the E. Okay? And eventually the IOER will be zero like it traditionally is. Okay? All right, so anyways, check it out. This is what we call open market operations. Okay? OMOs. The Fed today comes out and they decide to sell bonds, let's say. All right? So, the Fed sells bonds, right? The prices fall because the Fed is selling. They're pushing prices down. They're selling into the market. Okay? And because of that falling prices, interest rates rise. And you say, well, that's weird, right? And I say, yeah, well, there's an inverse relationship between price and interest rates. And you're like, yeah, I know you've said that before. I don't really get why. Okay, there's an inverse relationship. If bond prices fall, interest rates rise. Okay, but I still don't get it. And I say, okay, we'll check it out. The demand for money is here. Here's your D1. Okay, the Fed sells bonds. What does that mean? That means they give JP Morgan bonds, which then they just sell to their customers, right? And in exchange, the Fed removes money from JP Morgan's account into the Fed and removes it from the economy. It doesn't exist in the economy anymore. The supply of money has gone down. The equilibrium price, between the demand for money and the supply of money shifts because the supply of money has fallen. We get a new equilibrium. So price used to be, or the interest rate used to be here, but now the interest rate is here. This is the mechanism. So, listen. If the Fed decides they want to raise interest rates, they enter the market, the same market as everybody else, the bond market. And they sell bonds. They just come in, sell, 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 sell. And the Fed drives up. It's not like law. They don't pass a law like interest rates have risen a quarter point. They come in and they sell and sell and sell and sell and sell until they get the the interest rate to be exactly what they wanted. And if tomorrow afternoon at 1:42, the actual interest rate in the actual market drops a little below what they want, the Fed comes in, sell, 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 and they drive it back up. And then if it goes too high, buy, 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 and it drives it back down. So they actually adjust interest rates up and down real time, all day, every day, by either buying or selling. Okay? And they get it exactly what they want. So in this case, to drive up interest rates, they just sell, sell, sell. So let's take a look at another version of this. Then I'll explain why that is so important. Actually, I'm going to explain it now, actually. Here we go. Thank you, Papa Smurf. Yeah, so monetary policy is a clown show. Huh. Well, Adios, Papa Smurf. Amazing. I'm not sure what's in it for these people. All right, cool. Well, if everyone else is still with me with money supply, this is good. Okay, check this out. The Fed decides to buy this many amount of bonds, 10B. Okay? I'll show you something cool. Remember that R and the E? Okay? 10B. Total deposits, they're going to make a deposit, right? They buy bonds, so they're going to deposit 10 billion. 1 over R plus E times that deposit. This is the math we're working on. This is called the money multiplier. This is actually the reason why rich countries are rich and poor countries are poor. Do you know any poor countries with stable and trustworthy banking systems? Nope. And this is why. Okay? So, right? You do all this, do the math. The Fed comes in, buys $10 billion in bonds, and the money supply expands by 100 million. It's amazing. This is the fractional reserve part of the banking system. So let's do it this way. The Fed buys bonds from JP Morgan. The money goes to JP Morgan. It's in JP Morgan's banking account. So JP Morgan's banker has to put 10% at the Fed, but they're a bank, so the banker loans out the other 90%. The other 90% gets loaned out to somebody in a loan, which of course they take out a loan so they can spend it. So they spend it, which means it goes to someone's bank account, which banker number 2 now takes 10%, parks it at the Fed, takes the other 90%, loans it out. Whoever takes that loan spends the loan, which means the money gets transferred to another bank. Banker number 3 takes 10% of that, parks it at the Fed, and loans out 90% of that. That 90% gets loaned out. That goes to someone other bank. That bank makes a 10% deposit, loans out that 90%. Over and over and over and over. And at the end of it, when it gets down to like $1, so some banker deposits 10 cents at the Fed, they can loan out the other 90 cents, right? But when you get to zero, how much actually entered the economy through this banking system? 10 times more than the Fed actually spent. The Fed spends or creates, let's say, 10 billion, but the United States of America creates $100 billion worth of economic activity and growth. Don't even get me going on the velocity of money stuff. Okay? The money supply expanded by 100 billion and the Fed only created 10, which is really cool. So right? And by the way, poor countries don't do this. Why? They don't trust their banks, so they hide the money under their bed, or they put it in a coffee can and shove it in the freezer. It doesn't grow. It doesn't get loaned out. The bank doesn't invest it into your neighbor's mortgage or doesn't lend it out to the business down the street so they can expand. None of that money gets put into economic activity. The money doesn't grow through interest rates, right, in the freezer, in the backyard, or under the bed. Okay? Okay? So, no, it's not criminal. It's just, it's use. You don't use your money, it doesn't grow. And if it doesn't grow, you have a stagnant economy. So put it this way. There are people with excess money you're not using right now. It's in your bank account. And then there's somewhere else, there's an entrepreneur or a business, for example, or your neighbor wants to invest into a 30-year investment like a house, and they're short on capital. You have excess, and you're like, I'm not using this, but it'd be really cool if I got a return. I'd like my money to grow. So the banker says, okay, I'm going to pay you an interest rate if you allow me to use your money. This is why checking accounts don't pay interest. Okay? And this is why things like CDs or certificates of deposits do pay a high interest, because now it says to the banker, all right, banker, go ahead and loan my money out. So they loan it to your neighbors so they can buy a house, but now there's an asset. or they lend it to a business down the street that can buy more equipment and hire more people or get a bigger facility. And that money you're not using gets used by someone else who then creates economic activity. Okay? So this is very, very, very important. Poor countries don't do that. The money sits under a bed. It doesn't grow with interest rates, but the neighbor doesn't get to create economic activity out of your money, nor does the business down the street. So your neighbor stays poor, and the business down the street stays poor, and of course then you stay poor and everyone stays poor. Okay? So anyways, let's continue with this. I'm not even gonna get close through this. Okay, so let's skip this. Okay, I'm going to go really fast through this, okay? So the Fed is not one central bank like most countries have. The Fed is a series of banks. The reason they have a bunch of banks is because Americans didn't trust the king. That's why they left England and they came to America, and they're like, we don't want a king. So they decided to have a president, give him limited powers. The same thing, like they didn't want centralized power for a central bank because it seems like, it could just be too powerful. So instead they made a bunch, right? So anyway, so how did it all begin? Well, JP Morgan, the dude in the middle that looks like he's golden, because he is golden, JP Morgan, okay? JP Morgan bailed out the US economy. In fact, he actually one time bailed out the government. I'm not joking. The United States government ran out of money, and JP Morgan lent the government money to keep the United States solvent. Okay? So after doing this a couple of times, bailing out the entire economy and bailing out the entire government, he's like, this sucks, dude. It's not my problem. Shouldn't be up to me. Okay? So he said, you know what? He called up all his powerful buddies because he's the richest guy in the world. He's got a lot of friends. He's like, you know what? Let's create a central bank. This is actually the third version of it, but they went down to Jekyll Island and they made a bank. This is them. This is the first Fed meeting. Okay? Okay. And by the way, I was there. Not there at that time. I've been in this actual room. Cool. So anyways, here's the central banking system. Okay? There's central banks all over the United States. One in San Francisco to represent all the West Coast. One in Detroit. I don't know why in Detroit. Anyways, they're spread around because they want fair representation, right? Because honestly, even 100 years ago, right? Farmers, let's say in Kansas City, right? They didn't trust bankers in New York, and they certainly didn't trust politicians in Washington, D.C. So the only way to get this passed, the only way JP Morgan and his buddies could get this central bank is to set it up this way where there's representation, which is the American way anyways, right? So anyways, every region has its own central bank, even though New York, Chicago, and San Francisco are the big ones. Each region has its own bank run by its own commercial bank members, and they own stock in this corporation. It's kind of neat, okay? And so what they do is they elect 6 directors, and then in Washington, D.C., the Board of Governors does the other ones. It appoints 3 more, okay? So there's 9, right? There's 9. Anyways, so 3 are bankers, 3 are business community leaders, and 3 could be academics, let's say, right? Economists, all right? So this is the whole idea, is to provide a well-rounded view of the economy when they get to things like the FOMC meeting, okay? So anyways, the Federal Reserve System, the leaders and the staff for each region's central bank gather economic statistics. This is backward looking. You may have heard of this as the Beige Book, okay? But they also meet with local members and business people. So like in San Francisco, maybe Janet Yellen used to meet with Sergey Brin and say, hey, so how's business at Google doing? And then she documents that in the Beige Book, right? So they look at backward statistics and they try to get forward-looking guidance, and they put all this in a book, and this is actually shared publicly. You can read it, okay? Now, the Board of Governors, the big bosses. This is in Washington, D.C. It's across the street from the Vietnam War Memorial. There'll be thousands of people at the War Memorial. There'll be nobody over at the Board of Governors building. It's kind of interesting, okay? Even though they're probably more important than the President of the United States, but they can't bomb anyone, but they govern the value of money and the availability of credit. So they determine your lifestyle, okay? So anyways, let's go back. There's 7 governors appointed by the President of the United States and confirmed by the Senate. So it's a big deal to become a member of the Board of Governors. They serve 14-year terms and rotate so that the president can't just say, I don't like you, Jay Powell, you're doing a bad job, you're fired. You can't do that. So Jay Powell's like, dude, when you're long gone, I'm still going to be here, all right? So that's really important, right? Many other countries are not like that. Each governor must be from a different district. They can't all be New Yorkers and they can't all be DCers, right? So anyway, so it's well-rounded, okay? And then the governors elect a chairperson, okay? This is a very powerful position. The president of the board, or the chairman of the Board of Governors, meets with the President of the United States, delivers these press conferences, testifies a couple of times a year in front of Congress, has the power to negotiate economic matters with foreign governments. Remember during the great financial crisis when capitalism was on the teeter of breaking? Ben Bernanke called up a whole bunch of central bankers around the world, and they all made a coordinated move. Unbelievable. The most amazing moment ever. Coordinated move. You know what? Ben Bernanke didn't ask the President of the United States for permission. Okay? So anyway, they can do all this, and they're also the chair of the FOMC, and that is the Federal Open Market Committee. Okay? Here's all the Fed presidents and the Board of Governors sitting around a table. There's Janet Yellen. There's Ben Bernanke. Okay? And down here, they're all staffers. They can be there, but they got to keep their mouth shut unless they're actually Board of Governors staffers. And then each have, or not each, but some of these guys do have presentations to deliver. So they meet 8 times a year. They set monetary policy for your open market operations. And some vote, some don't. Okay, I still got 10 minutes. I keep checking the clock. Okay? So all members of the Board of Governors, they vote. Presidents of the New York Fed, they vote. Why? They're the ones that do the OMOs. They're the ones that do the Forex stuff and the buying and selling of bonds, okay? 4 of the other 12, they vote. The other 7, they get to deliberate and go through all the conversations and discussions, but they do not vote, okay? Now, the reserve requirement ratio and the discount rate is not set by the FOMC, but that is definitely a BOG thing. Okay, so meeting 1, day 1, this was yesterday. They get together, the FOMC now. The FOMC get together, and the first thing they do is they approve and ratify the last meeting's minutes, right? Which you have read. You read the Fed meeting minutes, don't you? Then the report of, right? The manager of open market operations for foreign currency and domestic operations gives the very first speech. The Forex dude speaks first. What does that mean, huh? Then they have ratified those OMOs. So they basically say, yeah, you were asked us to keep interest rates at this rate, so we did. We bought and sold and sold and bought. We kept interest rates right where he asked us, and everyone's like, yeah, you're golden. Thank you. But it's actually a desk in New York. They actually do it. Trading just like you and me. They actually sit there and trade, manipulating interest rates to keep it in their range, okay? So, anyways, then the staff presentations start, and they do with the Green Book. This is the national forecast. We think this is what the U.S. economy is doing right now. Great. Each president then gives their regional economic overview. So Janet Yellen used to step up and say, this is what's happening in California, right? And then someone from New York, yo, this is what's going on up here, right? And they all go through and they give their overview of what has been happening in the region and what they think is going to happen in the region, right? But they're not talking about policy. They're just doing the State of the Union for their little region, okay? The State of a Region address, okay? Cool. Now, they go get drunk somewhere and they do some line dancing, And then the next day they come out and they do the Director of Monetary Affairs presents the scenarios for monetary policy. They're like, look, guys, don't even think about raising interest rates. Don't even think about it. Second thing, here's what I think will happen if you don't cut interest rates today. I think this, and this. For example, 99.4 of traders have already priced in that you're going to cut today. So you kind of have to cut today, because if you don't, it'll be an economic disaster. So you have to cut today. So lastly, here's what I think is going to happen when you cut today. Okay? And then they give the overview. So it's sort of scenarios, right? Now they all get together and say, well, which scenario do you like? What do you think? Should we cut? Should we not cut? Right? So they discuss it. And while this is happening, the chairperson or somebody, maybe the secretary, is drafting the statement. Okay? So now the chairperson says, all right, guys, this is what we're going to do. We're going to cut, but you don't like it, and you know, whatever. You're going to cut, and this is what we're going to read out. They like it or not, right? They get the wording just correctly. Then they vote. Okay? And then the policy statement is then released. So that's going to happen minutes from now. Okay? So they do some other things, but we'll get toward it, right? They do some supervisory stuff for banks and stuff like that, but not necessarily monetary policy. Okay? All right. So did anybody like or appreciate that presentation? I know it was fast, but was it helpful? Okay, it seems like there's lots of hecklers lately, so I don't know if you want me to be boring and dry. You know, right? Or if I'm too goofy, maybe I'm goofy. All right, I'm goofy. I love life, I live large. I'm so sorry. Okay? Cool. Yeah, cool. And maybe, just maybe, that Forex Academy guy was running a competing service and was trying to troll new members or make me look bad or something. I don't know. Maybe it's just me. So let's do, let's pull up the announcement. We have about 4 minutes. Yeah, I guess so, Ronnie. It doesn't hurt my feelings. It's just amazing, like, I feel bad for them in the sense, like, they wake up like anybody else and decide to use their life on Earth to do that. But anyways, it's kind of tragic. What'd you do today? Oh, I interrupted and ruined someone else's good thing. Oh, that's nice. Oh, yeah, he's not doing his webinar. Yeah. So anyways, cool. Well, I appreciate you guys, and I'm doing this for you. No one's asked me to do it, okay? This is just something I haven't publicized this. I haven't promoted this. The only way you really knew about this is you're a subscriber to the Forex.Today YouTube channel. So thank you for being a part of the Forex.Today YouTube channel. Okay, cool. So we got that. That's the 230. Wow. Yeah, I guess I should not be proud of how hard I worked for my Harvard degree. You're right. I should be ashamed. I should probably hide it. Yeah, I probably should. Okay, what was I going to do? Boy, that's distraction. I wanted, okay, I brought up the, oh, I know what we needed. News. Yeah. Cool. So anyway, so we got the news. There's going to be a release. Okay. That's interesting. Then we got the real news that 230. So there's going to be some volatility, but remember, it's all been priced in. So I wouldn't expect crazy volatility because it's already been played, right? Scalping, yeah, I guess. I'm more interested in setting things up for November and stuff like that. But this should have a pretty big impact on high yield currencies, emerging market high yield. So I want to check those positions there. But yeah, the conference is going to be the bigger one. It's tomorrow, but thank you. How are you doing? We got about 90 seconds. Yeah, it's tomorrow. I'm going to be an astronaut. Yeah. Well, the Prince Philip, the biggest thing is identifying the end of that trend, right? The end of the Fed cycle. And once you got that, then the rest is just golden, right? So, okay, just seconds now. Well, FX Victor, cheap money is better for businesses to borrow than expensive money. Okay? French. What about, all right, here's, look, this is a live account. All right, are we past all this now? Cool. Trade to the news. The person I knew there that was there since they were a startup left, and they didn't renew my license. They don't know anything about anything about anything. And they're like, no, we don't want to do this anymore. And that was it. Okay, cool. Cool. So we obviously got cut. Yeah. Cool. Nice. Let me fit this better. Oops. You are not alone. Okay. So all we're at, right, is the central pivot. Okay. So this is actually part, remember, there's a plan A and there's a plan B. And we had this days ago. Okay. Right? That's cool. Remember, I do a daily webinar, guys. So if you're new to this channel, I do a daily webinar. And so we have this already planned for this and for this. Okay? Plan A and plan B if you're going to resume the bearishness. And of course, the double bottom is here. So it comes down to bullishness or bearishness. Okay? Yeah. Right? But now you have to time it. Okay, Danielle? So now you have to time it. It's not like all day, every day. So if you should make that part of your bias and then look for those types of trade plans. Okay? I want to look at a different point of view here. You guys are funny. Yeah, volatility is insane. It's only moving 40 pips or something. Okay? So, like, key things that are actually interesting to the market right now. Let's delete this. This is going to be interesting because we're in the November sell zone and we're definitely at a key price that's interesting, right? So it comes down to your bullishness or bearishness. And there's sort of this thing going on next week if you're a bear. And the opposite, if you're a bull, you want it to rise up, drop back, and maybe go this way. So it's always going to be based on your bias, right? So you shouldn't be buying here now, but you could be looking to sell it. So now if you're looking to sell it, for example, you would be on a smaller time frame. Let me drop this, right? And you'd be looking for it to roll over, okay? You'd look for an up, down, and up and down. If you're a bull, right, you need the down and the up, okay? But the down is actually way down here, okay? So here's the interesting thing. There will be people in this market that are not looking at the longer term prospect of the Fed being at the end of the cycle and therefore the dollar weakening. So the initial move could strengthen the dollar and then weaken the dollar, right? So that's why you get this volatility. You need to know what your opinion is, right? So you have to answer the simple question, do you think the Fed is done cutting interest rates? If so, dollar weakens. If you think the Fed is going to cut in December or maybe January, then you probably want to maintain sort of a neutral to bullish dollar stance, okay? Okay. Is a Fed interest cut good for global macro? Well, it makes borrowing dollars, let's put it this way. It's not the Fed cutting, I suppose, that's most important, especially to emerging markets. It's what happens to the dollar. Okay? So interest rates falling is good for emerging markets, but if the falling interest rates creates a scenario of dollar strength, which it should in the policy of cutting. Okay? In the trend of cutting interest rates over time, that trend strengthens the dollar, as I explained earlier and last week, based on behavioral finance, right? That shows you the dollar will strengthen. The strengthening dollar is worse is more impactful in a negative way than the falling interest rates are helpful in a positive way. Okay? So in that case, if you're an emerging market, interest rates have fallen, okay, that's great. But if you still have to spend more money buying dollars to pay back your loan, then it doesn't help you because you still have to buy more dollars, right? You see what I mean? So once we get to the point where interest rates have fallen as far as they are going to fall, and in that scenario, the new trend is either neutral or raising interest rates, then what you'll find is the dollar will weaken, and that will be great for emerging markets. Because it's not necessarily the interest rate, it's the actual acquisition of foreign money. So like Turkey, for example, it got into trouble because it literally ran out of foreign reserves. Normally a central bank has billions in euros and billions in dollars and all this kind of stuff. But when they had to pay back these loans, or more differently, the individual Turks or the Turkish businesses needed euros to pay back loans, they would call their bank and they're like, I need some euros to pay back my euro loan. And then the banker says, well, I don't have any euros. So he calls the Central Bank of Turkey and he's like, give me some euros. And all of a sudden, the Central Bank of Turkey is like, we don't have any euros. And all of a sudden, the central bank goes, oh my gosh, right? And then the banker says, oh my gosh, right? And then they tell their client, dude, we don't have any euros. You're going to have to go buy some in the foreign exchange market. Okay? And when that happens, okay, now you got to actually dump your lira and acquire dollars, which weakens the lira and jacks up the value of the dollar. Okay, so that cycle is much more important. Okay? So in this case, when the Fed is done cutting interest rates, the dollar will weaken, and that's when you should be buying emerging markets, right? It's funny, they just threw this on. I don't know why they did. It's interesting. Okay, so it's that kind of process. So we can take a look right now and see how that's impacting. Okay, so before the interest rate announcement, I was somewhere between $2,500 and $2,600. Now that the announcement has come out, nothing's really changed. I haven't really lost a dollar at all. Okay, so the way I look at it, like some of you guys are like, oh my God, look at the volatility. I look at it like nothing happened. Okay, and look at this. Lira, lira, yen, yen, lira. So I'm exposed to macro and emerging market forces. The Fed cut interest rates, nothing happened. As far as I'm concerned, nothing happened. Okay, see what I mean? But that's because, as I showed you on the Fed Watch tool, okay, the Fed Watch tool showed us they already negotiated those deals a month ago. Okay, again, not opinion. Banks negotiating with banks, and they're like, oh, I'll lend you this money, but you know the Fed's going to cut interest rates on October 30th. And they're like, yeah. All right, so we have to adjust our prices accordingly based on that known information. They're like, yeah, okay, I see that, okay. And they negotiate, and they're like, that's fair, dude. And they shake on it, and they sign the contract, but that was done 3 weeks ago. You see what I mean? Like, so why would it change things now? It was already done. That's old news. Priced in, done. Literally priced in. Now, some of you guys look at it and say, well, you mean they made the trades on the charts already? Oh, I got rid of it, right? No, here it is. What do I mean by priced in? No, like literally the price. Okay? The price. This is the price. The average price of this contract was $98.17 for a $100 loan to the government. Priced in. They priced that, but did they price it today? No, they priced it yesterday and the day before and the day before and the day before and the day. And look, they're pricing in these deals. Okay? Okay, we're pricing in these deals. So there's a 49% chance, according to the price, this price, the average price of these deals being negotiated by banks, lending to banks, based on this knowledge, they're not going to cut interest rates in December. They're not going to cut interest rates in January. They're not going to cut interest rates in March. Well, at least 50% chance they're not. Okay? Or up and through that period. 50% of all the bankers negotiating money, billion-dollar deals with each other, they're like, yeah, okay, I'll give you October, but they're not going to cut in December and January, March. Now, some of the deals were negotiated slightly different. They're like, well, we don't really know if it's December, January, March, but we're pretty sure by the time March comes in, the Fed's going to cut one more time. And so those are those deals negotiated. Those are just terms between two people, two banks in this case. They're like, okay, well, I'll give you that cut. I don't really think so, but I need the money. So, all right, fair deal, great. Okay? Baked into the price, not a survey, not sentiment. Okay? See what I mean? So it's really, really helpful information. So now if you're going to be interviewed by CNBC or Bloomberg and they're asking you about the, what you think about the Fed, you say, well, my research shows me that between now and March, I think there's only about a 50% chance that they're actually going to cut again. 50% chance they're pretty much done. And now, if you believe that, see, not everyone believes this, guys. 40% believes there's going to be one more cut between now and then in the next 100 days. So here's the thing. If you believe they're done cutting between now and March, you are selling US dollars. Okay? If you think they're going to cut one more time, Well, between now and then, you're going to be a buyer of US dollars. Okay? That's how it works. Your opinion versus mine, your bias versus mine. You're a buyer, I'm a seller. Great. Let the games begin. Now, the cool thing is now that's why we use technical analysis to say, well, if I'm a buyer, I want to buy here. If you're a seller, you want to sell there. Done. What do we do in the middle? Nothing. Okay? Nothing. That's what amateurs do. Okay? Was that good? Is there an aha moment? Are we connecting big money market, big smart, big institutional banker logic into actual pricing valuations of the dollar today? No. So PCNG says, right, make sure I go through this a lot. Maybe start attending my daily webinars. Make sure you subscribe to Forex.Today. There's a big misunderstanding with newer traders that are new to macroeconomics. If you think cutting interest rates weakens the dollar, and you think raising interest rates strengthens the US dollar, please write this down. You're wrong. You got it backwards. The US dollar is a reserve currency. Now, if you were talking about Aussie dollar, Canadian dollar, Kiwi dollar, Brazilian real, then you would be correct. Okay? But the US dollar is no ruble, my friend. Okay? So in this case, the reserve currency isn't that way. Okay? And I've already explained it, I think, once in this webinar, once earlier today, and probably 6 or 7 times over the last 10 days. So I don't want to do it again, but if you're having having a disconnect between fundamentals and setting up trades technically, then please subscribe to the channel and I'll cover it tomorrow and the next day and the next day and the next day and the next. I've been doing webinars on YouTube since it was a startup. Okay? Okay? So I'm here for you. So Amir says, if they're looking to cut interest rates further, why buy? So you were not here a half an hour ago. I specifically answered that question, but let me just answer it this way, Amir. Okay? Amir Saeed. Okay? An hour ago, you could have bought a Treasury for 1.75%, right? That's the interest rate on the Treasury. A half an hour ago, you could have bought that Treasury for 1.75. Now, I'm sorry, it's only going to pay you 1.5. You should have bought it. See, the fact it's falling, people are rushing to lock in the higher rate now. See, if you bought a 10-year T-note 18 months ago, it would be paying you 3% a year every year for 10 years. Wrong. Amir Saeed, that's exactly wrong. You're just as wrong as the other person that said the same thing. That is totally wrong. So we don't have much time in the webinar today, and I'm not doing this to be mean to you or belittle you or something. Look, give me another day, another week, another month, give me a year. Subscribe to the channel every single morning. I'm here for an hour or two every day. I can explain it over the course of time so you totally get it. But your answer is exactly opposite of reality. Okay? You couldn't be more wrong. If you were more wrong, you'd be closer to being right. Right? It's circular. So anyways, it's cool. I can fix that. But that's what makes sense, but that is not the reality. Okay? Fox says, 50-year bonds, here we come. Well, by the way, did you know Walt Disney, the company, the media company, the theme park company, they have 100-year bonds. And also, Austria has 100-year bonds. And I'm actually doing analysis on them. So I'm doing a big presentation at Harvard. Sorry, I'm bragging again. I have a big presentation coming up next week, comparing and contrasting these two century bonds. One is a corporate bond. One is a sovereign bond. So there are similarities and differences. Both are 100. One has an option, one doesn't. All these different things. Why would someone buy one? Why would one be the other? Would Disney let it expire? You know, take the option, or should they let the option expire? All these different things. It's okay. Okay. But the key thing I can leave you with is the difference is that the US dollar is a reserve currency. Okay. That's the difference. That's the big aha. So you can't treat it like everything else. Okay. Amir, or a PC says, Amir, it's worth more to buy the older notes than, all right. So now if I bought a Treasury, right, a half an hour ago, it's now worth more money, because I'll say, look, if you want to buy my note that pays 1.75, you're going to have to pay me a premium, because I know right now if you go to the market, you go to the Treasury, you're like, I need a note. They're like, we pay 1.5. Well, I was smarter than you. I bought it a half an hour ago. So if you want mine that pays higher, you're going to have to pay me a premium. You have to raise your price. Okay? So interest rates fell, but price went up. You're going to have to pay me more now. Okay? That's what it's all about. Okay? Okay? It's neat, right? Yeah. Well, remember, I brag about my macroeconomics degree from Harvard with honors, where Angela Merkel spoke. Remember, I'm a bragger, as the 3 or 4 hecklers have indicated today. So I keep looking at the clock, that's all. So maybe that doesn't bother you, but yes, I can do the math. I have the credentials. Right. Yeah. Oh, thank you, Ron. Right. So anyways, love the bragging too. Nah, come on. I'll tell you, it wasn't easy. So I don't know if it's bragging or humility, or I don't know. It wasn't an easy degree. I learned macroeconomics from someone that actually is a senior economist at the Fed. I've debated the minimum wage with someone that works at the New York Fed for a whole weekend. You know, like, dude, got the credentials. What books do you recommend? For Forex, I don't know, because when I started trading Forex, there were no books. Okay? So I don't really know. I wrote a book, but I don't want to be accused of that bragging or selling you that, so I don't care. You can buy my book or not, and it doesn't mean anything to me. You can do whatever you want. Other people's books, I don't know. Now, we were talking about this earlier, like, I'd like to start a group where we read all the philosophical authors of economics and finance throughout history, starting way back with Machiavelli in, I think, the 13th century Italy. His book called The Prince had to do with the Medici and the king. Okay? So imagine that. We can go all the way back. The Medici. So, in my class at some institution I won't mention, we were reading about the Medici, and then they said, by the way, if you go to the library at this institution I won't name, we have the oldest accounting book in the world, and it's a book from the Medici. Okay? And they're doing a double entry accounting system for trading wool. Okay? What are my PCNG says, what are my thoughts on reflexivity in George Soros? Well, I don't know if you know this. Here it comes again. Here's a burn-in. I'm going to brag. I sat on a board of directors with George Soros. Jumbo! Benjamin, Jumbo. Okay? I have the annual report. I was elected to the board of directors. Yeah. But we never had a chance. I was 21 or 22. He was a little bit older. But I would love to be able to say, you know, he put his arm around me and said, son, you have a bright future ahead of you. I think you should throw yourself into becoming a foreign exchange trader just like me. That'd be cool. He didn't. Okay. But anyways, I went on to be a successful entrepreneur, and then I went on to be a venture capitalist, and then I ran into Forex. So it's my third career. Oops, I'm trying to get this. So anyways, I don't really know. I can tell you, though, George is interesting because he does things, and he's very misunderstood. He does things to prove that capitalism is not perfect. It's not that it's wrong, but capitalism is not perfect. And most people go through their life with their eyes closed, half asleep, and everything's taken care of. They just want to watch TV and go to bed, right? And instead, he sees that capitalism is the best way, but it's not perfect. And there are built-in flaws. And he exposes the flaws. Okay? So breaking the Bank of England was simply because everybody knew what England, or in this case, you know, all of the UK, needed to do to enter into the Eurozone. It was laid out. Each central bank needs to do this, 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 and this. And if all of that is achieved, you can enter the Eurozone. Well, George Soros says, well, if I know ahead of time, I can front run you. And by the way, I'm leveraged like 500 to 1 back then, right? So he's like, I have unlimited money, and you're telling me what you're going to do before you do it. So he was doing it to expose them. And by the way, I'm not going to tell you how I know this, but I believe he's been buying gold from North Korea for $30 an ounce. North Korea doesn't have any money. They don't have any cash. They have no foreign exchange reserves. They're screwed. So why is he doing this? Because he's evil? No. Because he loves capitalism, and he's going to show that the United States has threatened to bomb North Korea into the Ice Age. It's been a problem for decades and decades and decades with South Korea. It's just lingering and linger. How many presidents of the United States are going to deal with this? George Soros will put an end to it. Because one day they will run out of gold. And they'll spend the last dollar on their last Rolls Royce, driving someone from his palace to another palace. And on that day, they'll run out of gasoline. They'll run out of oil. They'll run out of brake pads. And everything will just stop, and North Korea will collapse. And in fact, China will have to bail it out because China wants North Korea there because they want a buffer between the Western world and their border. But China will have to bail out all of North Korea, and all the evil powers in North Korea will go away. And no one will be able to thank George Soros because nobody knows it. Yeah, of course he's ripping them off. That's the whole point. Okay? But if he got caught, he'd probably go to jail, but yet he's the only one that's probably likely to put an end to this nonsense. Cool. Anyways, nice to know you. Wasn't that fun? Shh. Don't tell anybody. Yeah. Yeah, right on. All right, so we got an announcement. They've cut interest rates. Is it the last one? Now, the first thing is we want to know, was it unanimous or was the board split? The more split it is, the less likely they're going to cut in the future, the more the dollar's going to weaken. I hope you understand this. Benjamin wants to sit down with me and smoke a cigar. Where do you live? Montreal? All right, well, maybe in the summer. Maybe in the summer. Whiskey Cafe sounds great. Toronto? Sure. Problem is, Toronto and Canada and everything is so expensive. Be cheaper to just go to Singapore. Yeah, R&J is fine. Oh, 2 dissenters? Cool. Yeah. All right. All right, thank you. Thank you, baby. That's awesome. Yeah, I'm not an R&J guy. I mean, they're good, but I'll probably get something else, but I wouldn't complain if someone gave me one. No, Jean-Guy, I remember taking a cab ride from my hotel across the park to another hotel with a view of the park, went upstairs, had one cigar, had one scotch, went back, took the taxi back to the conference center, which was right next to the tower, right? 2 10-minute taxi rides, one cigar, one scotch, and it was like $250. I'm like, dude. Right on, Joe. I like the Cohiba Bay Hike 56. There we go.
Good afternoon and welcome. My colleagues at the Federal Reserve and I are dedicated to serving the American people. We do this by steadfastly pursuing the goals that Congress has given us: maximum employment and stable prices.
Hey, we covered that today.
We're committed to making the best decisions we can based on facts and objective analysis. Today, we decided to lower the interest rates for the 3rd time this year. We took this step to help keep the U.S. economy strong in the face of global developments and to provide some insurance against ongoing risks. As I will explain shortly, the policy adjustments we've made since last year are providing, and will continue to provide, meaningful support to the economy.
Explain me, Lucy, explain me.
We believe that monetary policy is in a good place. The U.S. economy is in its 11th year of expansion.
Whoa. Did he just tell us he's
The baseline
done?
outlook remains favorable.
It's in a good place. Well, if it's in a good place, why cut?
The overall economy is growing at a moderate rate. Household spending continues to be strong, supported by a healthy job market, rising incomes, and solid consumer confidence. In contrast, business investment and exports remain weak, and manufacturing output has declined over the past year. Sluggish growth abroad and trade developments have been weighing on those sectors. Looking ahead, we continue to expect the economy to expand at a moderate rate, reflecting solid household spending and supportive financial conditions. The job market remains strong. The unemployment rate has been near half-century lows for a year and a half. The pace of job gains has eased this year, but has remained solid. We had expected some slowing after last year's strong pace. Participation in the labor force by people in their prime working years has been increasing, and wages have been rising, particularly for lower-paying jobs. People who live and work in low- and middle-income communities tell us that many who have struggled to find work are now getting opportunities to add new and better chapters to their lives. This underscores for us the importance of sustaining the expansion so that the strong job market reaches more of those left behind. Inflation continues to run below our symmetric 2%
Please subscribe to the channel, guys. I'm
Over the
doing a
12
webinar
months
tomorrow
through
morning.
August,
Please
total
subscribe.
PCE inflation was 1.4%, and core inflation was 1.8%. Inflation pressures remain muted, and indicators of longer-term inflation expectations are at the lower end of their historic ranges. We're mindful that continued below-target inflation could lead to an unwelcome downward slide in long-term inflation expectations. However, against the backdrop of a strong economy and supportive monetary policy, we expect inflation will rise to 2%. Overall, we continue to see sustained expansion of economic activity, a strong labor market, and inflation near our symmetric 2% objective as most likely. While this has been our outlook for quite some time, our views about the path of interest rates that will best achieve these outcomes have changed significantly over the past year. As I mentioned, weakness in global growth and trade developments have weighed on the economy and pose ongoing risks. These factors, in conjunction with muted inflation pressures, have led us to lower our assessment of the appropriate level of the federal funds rate over the past year. In both July and September, we reduced the target rate for the federal funds rate by 1/4 percentage point, and we did so again today, bringing the range to 1.5 to 1.75%. The policy adjustments
By the
we've
way,
made
this
to date
line
will continue to
represents on a
provide
1-minute
significant
chart the
support
value
for
of
the
the
economy.
US dollar versus all
Since monetary
other
policy
currencies
operates
at the
with a
same
lag,
time. Equally
the
weighted
full effects
balanced
of these
basket.
adjustments on economic growth, the job market, and inflation will be realized over time. We see the current stance of monetary policy as likely to remain appropriate, as long as incoming information about the economy remains broadly consistent with our outlook of moderate economic growth, a strong labor market, and inflation near our symmetric 2% objective. We believe monetary policy is in a good place to achieve these outcomes. Looking ahead, we'll be monitoring the effects of our policy actions along with other information bearing on the outlook as we assess the appropriate path of the target range for the Fed funds rate. Of course, if developments emerge that cause a material reassessment of our outlook, we would respond accordingly. Policy is not on a preset course.
If gold
Let
is
me
down,
end with
then
a few
that's
words
dollars
about our
up, which
technical
means
monetary policy
investors believe they're going to
operations.
cut one more time.
In January, we made the key decision to continue to implement monetary policy in an ample reserves regime. In that operating framework, we control the federal funds rate primarily by setting our administered rates, not through frequent interventions to actively manage the supply of reserves. In the transition to the efficient and effective level of reserves in this regime, we slowed the gradual decline in our balance sheet in March, and we stopped it in July. In response to the funding pressures in money markets that emerged in mid-September, we concluded that it would be appropriate to maintain over time a level of reserve balances at or above the level that
230
prevailed
viewers right
in
now
early
and only
September of this
109
year.
likes. Would you
To
guys be
achieve
so
this
kind to
level,
reach out
we
and
announced
click
on
the
October
thumbs up
11
button?
that we would purchase Treasury bills
Thank you.
at least into the second quarter of next year, as well as continue temporary open market operations at least through January. These actions are purely technical measures to support the effective implementation of monetary policy as we continue to learn about the appropriate level of reserves.
Dollar is currently strong,
They
so
do
the
not represent a
interpretation
change
is
in the
there's
stance
more
of
cuts
monetary
coming.
policy. In particular, our Treasury bill purchases should not be confused with the large-scale asset purchase programs that we deployed after the financial crisis. In those programs, we purchased longer-term securities to put downward pressure on longer-term interest rates and ease broader financial conditions. In contrast, increasing the supply of reserves by purchasing Treasury bills only alters the mix of short-term assets held by the public and should not materially affect demand and supply for longer-term securities or financial conditions more broadly. Thank you. I will be happy to take your questions.
Michael
Get ready,
McKee with
folks.
Bloomberg Radio and Television. So I guess the question is this it? Do you consider rates to be accommodative enough now to achieve your goal of sustaining the expansion? And as far as Global Wall Street's primary question, what kind of change in the economy would cause you to reassess? Some sort of significant deterioration in what?
So what we've said to repeat is that we see the current stance of policy as likely to remain appropriate as long as incoming information about the economy remains broadly consistent with our outlook.
Yeah, hang on. He's going to say
And
something.
we say
though.
that really because both of the performance of the economy and the stance of policy. The performance of the economy has been, particularly the household sector, has been strong, has been resilient, with low unemployment, attractive levels of job creation, wages moving up, labor force participation moving up, household confidence, and solid gains in many measures of consumer spending. The manufacturing sector, particularly manufacturing and also investment in exports, have been weaker, but overall we've seen moderate growth, a strong labor market, inflation moving
We're going to
up.
go to the pivot points.
We
Look
see
for
the outlook as
role
pretty well the
reversals.
same. We also see the risks to the outlook as perhaps having moved in a positive direction over the course of this intervening period, although some things remain to be seen. So that's the economy. Turning to policy, we've moved the stance of policy over the course of the year to a more accommodative stance. And after cuts at the last 3 meetings, the federal funds rate is now in a range between 1.5% and 1.75%.
By the way, if you want my chart
We feel that
templates,
policy
the
is
link
well
to
positioned to support
download
the outlook
them
that
is
I
in the
described. So
description
you asked
below
what
the
it would
video.
take, to move, and as I mentioned, we're going to be watching all factors, and if developments emerge that cause a material reassessment of our outlook, we would respond accordingly. But that's what it would take, a material reassessment of our outlook.
If I could follow up, if the markets decide that you need to cut rates again, will you be forced to follow?
We'll be looking at a full range of data about the economy and about the risks to the risks to the outlook. And I've given you a sense of what our outlook is. It's for moderate growth, a strong labor market, and inflation near our 2% objective. If something happens to cause us to materially reassess that outlook, that's what would cause us to change our views on the appropriate stance of policy.
Heather?
Hi, Heather Long from the Washington Post. You just said that the risks to the outlook are moving in a positive direction. I'm wondering if you could specify, is that on trade or are there other matters? This morning, we obviously learned that we've now had 2 quarters of contracting business investment, which would seem to be moving the outlook in the other direction.
So in terms of risks, what I was referring to there, the principal risks that we've been monitoring have been really slowing global growth and trade policy developments, as well as muted inflation pressure. So I was really referring there to trade developments. We have that phase 1 potential agreement with China, which, if signed and put into effect, could have the effect of reducing trade tensions and reducing uncertainty, and that would bode well, we think, for business confidence and perhaps activity over time. So that has the potential for being an improvement in the risk picture. Brexit, I would say as well, it appears that the risk of a no-deal Brexit seems to have materially declined. I think on both situations, there's plenty of risk left, but I'd have to say that the risks seem to have subsided. You ask about business investment. And that's right. Business investment has been weak, and today's reading was weak as well. And it was broad across equipment and other parts of all parts of business fixed investment were weak. That's consistent with what we've seen. But that's the economy we've had this year. What we've had is an economy where the consumer is really driving growth, and personal consumption expenditures were almost 3% in this quarter, in this first reading for the quarter. So overall, we see the economy as having been resilient to the winds that have been blowing this year.
Can I just follow up quickly? I mean, there's this concern that I sometimes hear that with businesses have cut investment, and are they going to turn around and cut employment, if they continue to be concerned. Can you give a sense of how the committee is thinking through that possibility?
Yes, so that is a risk. That's a risk that we've been monitoring, but we don't see it yet. We don't see rising initial claims or layoffs or anything like that. But the risk you mentioned of the weakness in the manufacturing and export and business investment parts of the economy getting into the consumer side of the economy, we really don't see that. What we continue to see is good job creation. Unemployment has declined again in the household survey. is now at a 50-year low, has been, at very close to 50-year lows for 18 months now. So it's a very positive. The consumer-facing companies that we talk to in our vast network of contacts report, that consumers are doing well and are focused on the good job market and rising incomes, and that's their principal focus. So that is the thing that's pushing the economy forward, and it doesn't seem to have been affected so far by weakness in the other areas.
Gina?
Gina Smilik, New York Times. Thanks for taking our questions. So you've previously sort of compared this rate cutting cycle to the insurance cuts in the 90s. And in both of those instances, the Greenspan Fed took those cuts back after a while. They raised rates again fairly quickly. And I guess I'm just curious what the onus is for doing that in this cycle. What would make you guys decide it's appropriate to raise interest rates again?
So the reason why we raise interest rates is because, generally, is because we see inflation as moving up or in danger of moving up significantly. And we really don't see that now. Inflation moved down in the first quarter of this year. We thought that was due to some extent to idiosyncratic or transient factors. That turns out to have been the case, so it's moved back up. But it seems to be settling in below 2%. So we really don't see that risk. And inflation expectations have also kind of moved down and sideways, both surveys and market-based over the course of this of really the recent months. And we think that inflation expectations are very important in driving actual inflation, and we're strongly committed to achieving our 2% inflation objective on a symmetric basis. We think it's essential that we do that. So we're not thinking about raising rates right now. There obviously will be times in the future where that will be appropriate. What we're really thinking now is that our current stance of policy is appropriate and will remain so as long as the outlook is broadly in keeping with our expectations.
Steve Leisman, CNBC. Mr. Chairman, I'm not to make light of it, but I'm a little bit, I don't know if you can help me out with the appropriate understanding of the word appropriate here. So the statement says that the committee is going to monitor the implications of incoming information for the outlook as it assesses the appropriate path of the target range. That tells me you could go either way. You came in and you used the word appropriate, that the current rate is likely to remain appropriate, which means you're on hold. So how do I walk away from this, and what should we walk away from this believing what appropriate means? Are you on hold and need to be proved wrong that you should remain on hold, or is it really you could go either way here? Thank you.
So we think that the current stance of policy is likely to remain appropriate, as long as incoming information about the economy is broadly consistent.
By the way,
with
that
our
was
outlook,
Steve Leishman.
which is a
That
positive
was
one of
perfect.
moderate
That's
economic
exactly
growth,
what we need to know. So
strong labor market,
this
and
answer is
inflation
important.
moving close to 2%. That's what we're saying about that. We also say, of course, if developments emerge that cause a material reassessment of that outlook, we would respond accordingly. So that's really how we're thinking about it. I can't point to one data point or one thing that would change our minds. It would be a reassessment of a material reassessment of our overall outlook, which is what I described.
I'm sorry, just to follow. Why isn't the phrase likely to remain appropriate in the statement if that's the sense of the committee?
Well, there's a lot of practice and science and history in terms of how much you put in the actual post-meeting statement as opposed to what we say in the press conference statement. It's a judgment call. I'm saying it now, so.
Thanks.
Nick?
Thank you, Nick Timmeros with the Wall Street Journal. You described the recent slide, Chair Powell, and inflation expectations.
All right, we got to talk about that. That was epic. That was great. So he's like, dude, Chair, J. You say one thing, but you write a different one. Which one do I follow, your statement or what you say? And Jay Powell said, do what I say, not what I wrote. So we still don't know. Because remember that point where I made a comment? I'm like, dude, the interpretation of what we're saying here is that they found their bottom. That's the holding point. But then he said something else later. And so I'm like, well, that's really confusing. You saw the value of the dollar change over that. And then Steve Leishman from CNBC says, so which one is it? So we're left with this great thing, like still nobody knows. So it's going to come down to your opinion. So if you thought the Fed was going to continue cutting, buy the dollar. That means you're looking for the support and resistance in that favor. If you think that the actual interpretation of what he said, not what he wrote, but he's just said, well, we think where we are is appropriate and will continue to be appropriate. Well, then you say, well, if you say it that way, then you're done cutting, I'm going to short the dollar. And then, of course, you can say, Ali, you're like, hey, man, it wasn't clear. Jay Powell said one thing, he wrote a different thing, and so I don't really know. Well, then you're dollar neutral. Okay? So let's end it this way. I want you to go back to the Chicago Board of whatever it is, a CME, the Chicago Mercantile Exchange, and look at the pricing differences between the Fed meetings for the money market futures. Okay? And then again, this is smart money, banks lending money to reach short-term loans or overnight loans for the Fed funds rate, and they are pricing these things over time based on their actual negotiation of billions of dollars of real money, and they're coming to compromise based on what everybody thinks rates are going to be in the future and actually pricing based on that. So 1,000 times better than opinion or sentiment. This is actually hundreds of billions of dollars being negotiated and priced based on expectations. Different, right? So pay attention, because these are going to fluctuate over the next few days as people interpret. Did he say we're on hold or we're not? Should be a simple question. You got to remember, Jerome Powell is not a PhD economist, yet he runs the central bank. All right, I didn't make that choice. But anyways, maybe that's a consequence. Okay? Maybe he wants to leave it open so he can change his mind next meeting. Like, that's not a good way to run a central bank. Now imagine you're a big corporation and you're like, hey man, I want to make an investment. I want to build a $1 billion factory and it's going to take me 5 or 6 years. What's the economic outlook for the next 5 or 6 years? And right now, with answers like that, we don't know. So how are you supposed to plan and value the risks that you're taking and in your future cash flows and all these things? You're not going to be able to, right, with that when you don't know what the policy is. Once you know the policy, once you know they're done cutting, sell the dollar. If you think they're going to continue cutting, buy the dollar. If you're not really sure, stay neutral and maybe don't trade that. Okay? Does that make sense? Watch the Fed Watch site, number one. It'll show you the differentials over time in pricing. And from that, you can derive the implied interest rate now and in the future. Second thing, subscribe to Forex.Today YouTube channel. Third, leave a like. Fourth, leave a comment. And fifth, have a wonderful day and I'll see you tomorrow. Thank you for being on my team and thank you for being here. Remember, I didn't send an email about this webinar. I didn't tweet it. I didn't put it on Facebook. This is simply my way of saying thank you for being a subscriber. And you got the alert, so you're here. So thank you very much. I've given you 4 hours of my life today. So thank you.